Good morning, team. Today we are going to talk about our company, FIN's financial analysis. Firstly, let's analyze the liquidity position of the company for 2023 compared to 2022 and evaluate our position against our competitors, Nestle. This will guide us in addressing our cash flow challenges. In 2022, the company current ratio was 2.67 times, improving slightly to 2.95 times in 2023. This shows that our ability to cover short-term liabilities using current asset has strengthened. Similarly, the quick ratio improved from 1.59 times to 2.05 times. However, this increase highlights that inventory now plays a larger role in our liquidity, which could limit our ability to respond quickly to sudden financial needs. Furthermore, compared to Nestle in 2023, our liquidity position remains stronger overall, while Nestle's current ratio was 0.61 times. Compared to our 2.95 times, their quick ratio of 0.22 times highlight a different approach to managing inventories and liquid assets. This indicates that Nestle may be managing their liquid asset more efficiently. We need to maintain our strong position while working close to this efficiency gap. Now, let's dive deeper into cash flow management and working capital. Over to you.
Thank you, Ms. Patricia. Before anything else, let's look at the company working capital and cash flow utilization. As for our working capital in 2023, the difference between current asset and current liability was Rm 1.66 billion, up from Rm 1.40 billion in 2022. This increase reflects better management of our current asset, providing us with more flexibility to fund operation, reinvest in growth, or pay down debt. However, there's room for improvement in how we use this liquidity. For example, our trade receivables declined to Rm 713.3 million in 2023, down from Rm 866.4 million in 2022. While this is a positive trend, further shortening collection periods can unlock more cash. Similarly, our inventory stood at Rm 764.18 million, a significant portion of current asset. Reducing inventory levels could free up additional resources for operational needs. Now, let's discuss the cash cycle, which measures how efficiently we convert resources into cash. Our cash cycle stands at 73.76 days, meaning it takes approximately 74 days for the company to complete the cycle from purchasing inventory to collecting cash from sales. By focusing on faster receivable collection and improving payables management, we can reduce the cash conversion cycle. This will minimize the time cash is tied up in operation, enhancing liquidity for future investment or day-to-day operation.
By the same token, I suggest we take a closer look at our credit policies and how we manage receivables. Since the trade receivables are valued at 713.3 million ringgit Malaysia, optimizing credit terms can unlock additional liquidity. Strategies like shortening payment cycles, offering early payment discounts, or automating collection processes can enhance the cash flow. Moreover, better inventory management is essential. Rm 764.18 million in inventory indicates the need to streamline procurement and production cycles. Faster inventory turnover can reduce cash tied up in stock and improve our liquidity position.
Last but not least, we must effectively communicate this finding to stakeholders. Our company has a competitive advantage due to its good working capital and liquidity ratio, which demonstrate financial stability. To maintain growth, we must reassure investors that we are tackling issues like cash cycle management and utilization. We can strengthen the stakeholder confidence by open communicate regarding our intention to maximize inventory management, increase collection effectiveness, and reinvest the extra cash. This story will be strengthened even more if we highlight how we outperform Nestle in important liquidity indicators.
Thank you, everyone. To summarize, FIN's liquidity remains strong but requires focused strategies to enhance working capital utilization and cash cycle efficiency. Our next step include optimizing receivables, streamlining inventory levels, and improving cash flow management. Moving on to our next agenda item, let's analyze the company's leverage ratio and compare them to Nestle. From 2022 to 2023, our debt-to-equity ratio rose from 8.81% to 22.54%, signaling increased reliance on debt financing, which raised financial risk. Similarly, our debt ratio increased from 28.7% to 34.43%, indicating more assets are now financed by liabilities. The sharp drop in our time interest ratio from 44.22 times to 13.04 times is most concerning, as it shows reduced capacity to comfortably cover interest expenses. Compared to Nestle, their debt-to-equity ratio is much higher at 69.67%, and their debt ratio stands at 81.09%, reflecting aggressive leverage. However, their time interest earned ratio of 15.39 times is slightly better than ours, indicating better management of debt obligations.
Thank you, Ms. Patricia. These trends show growing financial risk for the company. While debt can feel good, the rising debt-to-equity ratio and declining times interest earned ratio highlight vulnerabilities, especially if interest rate rise or earning drops. Nestle higher leverage works due to their scale and strong cash flow, but our smaller size means we must carefully evaluate whether we can sustain this trajectory. Therefore, this will require a detailed assessment of our cash flow projections and sensitivity to external risks such as rising interest rates.
Building on Ms. Aina's point, industry benchmarks suggest a debt-to-equity ratio under 50% and a debt ratio below 50% are ideal. While the company remains within this limit, the upward trend requires close monitoring to avoid crossing safe thresholds. The drop in our time interest earned ratio from 44.22 times to 13.04 times is particularly concerning, as it approached the lower safe range of 15 times. Although our leverage is less aggressive compared to Nestle, maintaining a healthy balance is essential as we explained.
Moreover, operating flexibility may be strained by rising debt, which would leave fewer funds available for improvement, marketing, or new product development. Nestle higher leverage is affecting because of its market power, but ours is more exposed to financial strain because of our small scale. We could minimize unnecessary risk while maintaining the flexibility required for sustainable growth by creating a balance between debt and equity financing.
Thank you everyone for your input. While the company remains stable, the trend in leverage are concerning. To reduce risk, we should explore refinancing debt at lower rates, consider equity financing to reduce reliance on debt, and carefully evaluate new investment to ensure high returns. A balanced approach will support growth while preserving financial stability. Next, let's move on to analyzing the company's efficiency ratios for 2023, comparing them to 2022 and our competitor Nestle. Understanding this metric will guide us in improving how we manage our assets and liabilities to maximize operational efficiency. In 2022, the company's inventory turnover ratio was 3.66 times, which improved to 4.67 times in 2023. This shows faster movement of inventory, meaning we are more efficient in selling our stock. The average collection period also shortened significantly from 69.77 days to 51.35 days, reflecting better customer payment timelines and quicker cash inflows. The fixed asset turnover ratio improved slightly from 3.007 times in 2022 to 3.14 times in 2023, indicating a marginal increase in the efficiency of utilizing fixed assets to generate revenue. However, our total asset turnover ratio decreased from 1.07 times in 2022 to 0.98 times in 2023, signaling room for improvement in utilizing our assets to generate revenue. When compared to Nestle, FNN is still behind. Nestle's inventory turnover ratio is higher at 5.80 times, indicating they manage inventory more effectively. Their average collection period is much shorter at 23.64 days compared to our 51.35 days, which allow them to free up cash more quickly for reinvestment. Nestle also demonstrates a higher fixed asset turnover ratio of 4.03 times compared to the company's 3.14 times, reflecting greater efficiency in converting fixed assets into sales. Additionally, Nestle's total asset turnover ratio is 1.98 times, nearly double ours, showing they generate significantly more revenue per ringgit of assets. These differences highlight the areas where we must improve.
First of all, to further improve our inventory turnover, we should refine our demand forecasting to align stock levels more closely with market needs. Implementing a just-in-time inventory system could also reduce holding costs and ensure cash is not tied up unnecessarily in excess stock. Additionally, partnering with suppliers to improve lead times can make our supply chain more responsive and efficient.
Thank you, Ms. Farah. From a sales perspective, we need to focus on increasing revenue generation. This can be achieved by promoting our high-demand products, introducing more targeted marketing campaigns, and offering competitive pricing strategies. Boosting sales not only enhances asset turnover but also strengthens our position in the market. We also need to address our collection period. Offering discount for yearly payments or tightening payment terms for customers could reduce this time frame, ensuring faster cash inflows. By improving our cash cycle, we can free up resources for other strategic use.
Besides, workforce productivity plays a key role in improving efficiency. For instance, providing targeted training to employees in inventory management, customer service, and sales technique will help us operate more effectively. Automation tools such as inventory tracking system or automated invoicing can also reduce manual errors and streamline processes. A motivated and well-equipped workforce will significantly boost efficiency across all areas.
To summarize, our efficiency metrics show some improvement but also highlights areas where we lag behind Nestle. Key action include optimizing inventory management, strengthening sales strategy, enhancing receivable collection, and improving workforce productivity. These initiatives will allow us to increase efficiency, close the performance gap with Nestle, and strengthen our overall financial health. Team, let's now turn our attention to the company's profitability ratios for 2023 compared to 2022 and benchmark against Nestle. This will help us understand our financial performance and identify growth opportunities. In 2022, the company's gross profit margin was 26.27%, which improved to 28.969% in 2023. This reflects better cost control or higher sales pricing. The operating profit margin also rose from 10.02% to 12.89%, showing increased efficiency in managing operational costs. Similarly, the net profit margin grew from 8.55% to 10.84%, indicating higher overall profitability. Our return on asset increased from 9.12% to 10.60%, while return on equity climbed from 12.81% to 16.17%. This means we are generating better return on both asset and shareholder equity. The next slide will show the difference between FNN's ratio and Nestle's ratio. When compared to Nestle, the company's gross profit margin of 28.69% is slightly lower than Nestle's 31.04%, indicating room to improve cost efficiency or pricing. Our operating profit margin of 12.86% is also below Nestle, which is 13.32%, suggesting that we can refine operation further. However, FNN's net profit margin of 10.84% is higher than Nestle's 9.36%, showing better cost management after operational expenses. For ROA, Nestle outperformed us at 18.49% and their ROE 97.77% is much higher, which highlight their strong equity returns.
Thank you, Ms. Patricia. From a marketing perspective, pricing strategy is one important factor of fighting revenue. We may be lacking in cost control or pricing as evidenced by our comparatively lower gross profit margin compared to Nestle. Without drastically increasing expenses, we could boost revenue by reviewing our premium service pricing or bundling offer. Another factor to consider is promotional campaigns. Increasing occupancy rate during off-peak season through stronger digital marketing initiatives might improve gross and net margin. Additionally, adjusting service to fit changing consumer tastes, for example by providing eco-friendly or luxury-focused options, may attract higher margin customers.
Additionally, our operational efficiency needs a closer look. While our gross profit margin improved, it's clear that some cost structures like utilities or labor might still be limiting our net profitability. We should invest in streamlining operations like adopting energy efficient technology or optimizing staffing levels during low demand period. Another focus could be renegotiating supplier contracts to reduce cost burden. These efforts can directly improve our net margins and ROE.
On top of that, industry benchmarks suggest our profitability ratios are improving, but still behind top performers like Nestle. The gap in ROA and ROE is particularly concerning as it indicates we are not fully capitalizing on our asset base or equity. To address this, we might explore reallocating underperforming assets to higher yield investment. For example, converting low-performing locations into boutique-style facilities could generate higher revenue per asset. In addition, evaluating high-margin service like event hosting or personalized experience could align with industry trends while enhancing profitability.
In conclusion, FNN has demonstrated solid improvement in profitability ratio. However, when compared to Nestle, there are still areas that need attention. Our next step should include refining cost management, focusing on high-margin product, and investing in initiatives that improve efficiency. I believe we can wrap up here. Let's use this insight to drive sustained growth and communicate our progress effectively to stakeholders. Thank you, everyone.
Thank you.